This is Financial Standard, the definitive source of news, thought leadership and analysis for Australian wealth management professionals. Financial Standard. Take the lead.
Hello and welcome to the Financial Standard podcast. I'm Managing Editor Jamie Williamson, and today we're bringing you something a little different. Our recent Financial Standard Advisors in Focus event in Melbourne, supported by HMC Private Credit, took a dive into all things private credit. In a wide-ranging conversation, our expert panel discussed the key drivers behind the rise of the asset class, the role it plays in an investment portfolio, and importantly, shared the top due diligence tips for advisors considering dipping their toes in.
It's a pleasure to have you all here with us for Financial Standard's first ever Advisors in Focus event. And to those tuning in on the Financial Standard podcast, thank you very much for joining us as well, as today we look to navigate the private credit boom together. My name's Julian Clarkstone. I'm an Associate Director of Marketing with ISS Market Intelligence, the publisher of Financial Standard. And I'm excited that we've got plenty of ground to cover in this discussion, talking all things, as we know, private credit. Now, the asset class has reached over $200 billion in assets under management, and we're seeing plenty of growth in the industry and also in terms of the investment opportunities that are available. However, there is also a spotlight on the industry of late, whether that's from the regulator, from media, and from the wider wealth management landscape as a whole. So we thought today's discussion was a perfect opportunity to get together and talk about the opportunities that lie ahead, as well as the challenges. We're going to delve into due diligence, not only for the advice community, but also for the product providers. And then we're going to look at how you can have confident discussions with your clients that help build trust. Now, I'm really excited. We have three presenters here to take us through their thoughts today. So thank you very much for joining us, guys. We have Craig Schloeffel, the head of HMC Private Credit, Travis Schindler, a partner and wealth advisor at Hewison Private Wealth, as well as Calvin Richardson, Senior Investment Consultant at Zenith. I'm really excited. Let's get started with this discussion, and can we please make our speakers welcome? Thank you very much for each of you joining us here today, and also for the preparation in advance. We greatly appreciate all of the discussions beforehand to make this happen. Now, I think we'll get started with a bit of a snapshot from each of you. I'm just keen to get a bit of an introduction about what you do, how your role engages with the private credit market, and then potentially a couple of words on what the most common questions you're getting about the space are at the moment. And Craig, I might start with you and then we'll go around.
Yeah, great. Thank you. So Craig Schloeffel, I'm the head of HMC Private Credit. HMC is an Australian Stock Exchange listed group. And within that, they manage around $20 billion of assets across 5 alternative asset classes. And one of those key verticals is private credit, which is our asset class and what we're here to talk about today. Within our private credit business, we manage around 2.2 billion AUD of predominantly real estate private credit, but we're going to talk about what other aspects of private credit there are in market referencing your 200 billion number. Our current book, as I said, is predominantly mid-market residential real estate-backed private credit. The most common question we get still today around private credit is, what is it? How should I think about it? What are the key risks? And where does it fit in my portfolio?
Well, without getting too far ahead of ourselves, the first question after that is we're going to talk about what private credit is. So we'll get to that very shortly. Thank you very much. Travis, over to yourself.
Hi, everybody. My name's Travis Schindler. I'm from Hewison Private Wealth. I've been with the business for 10 years. This is our 40th year in business. Manage almost $3 billion of client funds. We've been using private credit, real estate secured lending predominantly for almost 3 decades. More recently into corporate credit, but we're very comfortable with the space. I wear 2 hats in the business. One of them is a private client advisor managing a group of family clients, and the other hat that I wear is also one of 4 members of our investment committee. Some of the questions that we get most commonly are why are borrowers not going to the banks, and are these borrowers high risk? So that's something that we address quite commonly, and actually doesn't take long to overcome those hurdles when we educate clients a bit more around the space and how it fits into portfolios.
And Calvin?
Good afternoon, everyone. My name's Calvin Richardson, a Senior Investment Consultant at Zenith Investment Partners. For those of you that aren't familiar with Zenith, we've been providing ratings to the advice community for the last 23 years or so. And for the last 11 or thereabouts years, we've been building bespoke SMAs for the advice community as well, where we manage about $6.5 billion in AUM. So in terms of my role, predominantly focused on fund selection, asset class research, asset allocation, portfolio construction, and how we work within the private credit ecosystem. And I'm sure we'll touch on this later on in the discussion. Historically, it's been really challenging to fit, illiquid strategies into SMAs. So we predominantly run daily liquid SMAs, and then in parallel to those, we'll run illiquid strategies such as private credit through paper-based portfolios where we can aggregate up all of the reporting so that the advisors still have the administration efficiencies from a reporting perspective. But we are seeing lots of innovation from on the SMA front, and we're looking to launch a private assets SMA in the near term as well, off the back of some innovation from the platforms too. Very briefly, in terms of the key questions that come up, invariably it's around, how do the fund managers provide liquidity for what is a fundamentally illiquid asset class? So just providing some guidance around the liquidity mechanisms there. And also there's this, instinctive, reflexive concern around gating, inevitably, with any private markets type strategies. So that's always a key focus in client conversations as well, risks of gating and what will trigger a gating event.
Fantastic. And we'd obviously like to get some questions throughout the presentation today. So at any point, if you have a question, feel free to raise your hand. I'll also leave some QR codes on the screen in a moment. If you wanted to ask questions through the app as well, they'll come straight through to me. So please feel free. But to go back to one of the things you mentioned before, Craig, it might sound like a very simple question, but there's a lot more to it. Do you mind taking us through what private credit is?
Yeah, and I think this is probably one of the biggest misconceptions out there, particularly, as you said, with some recent focus on it from major newspapers. When we read the newspapers of late, it's troubles in private credit. And the biggest problem is private credit is huge. There's so many different aspects to private credit. And as Travis said earlier, mentioned too, there's about 8 to 10 different parts of the private credit spectrum, starting from corporate and asset finance, so asset-based private credit, moving through different parts of that spectrum into corporate credit, which is everyday lending to companies against their balance sheet, and then over to the part that we play in, which is the real estate-backed or hard asset-backed private credit. And within that, there's multi-spectrum. And if I just give you an example, within the real estate private credit sector, which represents around 75 billion or 15% of all commercial real estate debt in market today. Within that sector, you've got subsectors of property debt. So property is nuanced, of course. You've got residential, industrial, agricultural, office, hotel, specialist, healthcare. I could go on. There's so many different parts of that spectrum. And so when you're explaining to someone what is private credit, ultimately at its highest form, it's mainly high net wealth and wholesale, but also in some aspects, retail clients who are given the opportunity to invest their funds or on-lend their funds to a borrower who then uses those funds in the everyday course of business. The manager in the middle's job is to allocate those funds, manage the process of whatever they're investing in, and then return those funds on the basis of the loan that they've provided back to the investor.
In terms of, there's quite a lot to unpack in that conversation. And then, Travis, from the advisor's standpoint, it might be a lot to go through all of those different things, but how do you break that down? And you said you were able to sort of, build that confidence in those discussions. What are you going through in those discussions to actually explain what private credit is and the different types?
Yeah, reasonably similar to what Craig said. When we're sitting in front of a client that necessarily hasn't invested in this space before, we're explaining that they're acting as the lender. And from their perspective, they're lending to borrowers, and those loans are secured by property. We only operate in the senior secured or first mortgage space. So we're talking about trying to educate clients on what happens when things go wrong. First in line to get your money back in that event. But really, we're just talking to clients about their perspective as an investor, that they put $1 in, they take $1 out at the end of the loan term, and along the way they get a predetermined rate of interest. So that's it in its simplistic form. But there's certainly more nuances to it around, different types of borrowers, different purposes of loans, the construction, or as Craig said, is it residential housing that you're lending against, or is it even, commercial development or a multi-asset style syndicate? So there's a very, very vast range of subsectors within real estate private credit, but we try and bring it down to its simplest form, that it's capital secure if done right, low volatility, and it's a mechanism for income within the portfolio.
And how are you allocating with those different types with clients at the moment?
It hasn't really changed over the long term. I've been, as you can imagine, or understand, we've been very big supporters of private credit for many years. So I'd say on average, somewhere between 10 and 20% of a client's diversified portfolio might sit within that asset class, depending on their needs and circumstances. So we are very comfortable with it. Quite quickly, as I said before, clients and investors do become comfortable as well when they see how it operates, the layers of diversification, and how they're actually protecting their capital within the portfolio. So, we're very big supporters. We classify it as fixed income. I know many other groups have their own definition of fixed income and where this actually sits within the portfolio. It could be an alternative, but we classify it as fixed income. Roughly half of fixed income goes into real estate secured lending. So in recent years, it's probably reduced a bit. It maybe was higher once upon a time. And the only reason for that is that the range of private credit products that, Craig touched on a few of them within Australian investors have got access to has improved. So we've been able to, again, diversify even more.
Fantastic. Now, the topic today is obviously called navigating the private credit boom. I think the word boom is quite important there. I was having a look at Rainmaker Information's latest managed fund net flows report only the other day. Now, the growth of credit as a broader industry has outshone all the others by quite a margin, which was glaringly obvious to me. And even at an institutional level, superannuation funds have increased their allocation by 75% over the past 2 years. So I'm curious, this is probably one for each of you, if you wouldn't mind. But Craig, I'll start with you. What do you think are the product and the macro considerations that are driving that growth?
Yeah, so I think the number one consideration, particularly for larger institutional groups, is the maturing of the market in Australia. The private credit market is becoming much more sophisticated with larger players bringing in institutional grade platforms. Prior to probably 2013, the introduction of Basel III in Australia, our private credit markets were in their infancy. It was more of a cottage industry, and we've seen significant growth thereafter. I'll just talk about the boom for 1 second because it's interesting. Australia currently in real estate debt, about 15 to 17% of the market is private credit, with the rest banks and offshore banks. If you compare that to international markets, we're only just getting started. What I mean by that is in the US, real estate credit in the private sector is somewhere between 45 and 50% private, and the rest banks. We're at 15. In Europe, it's somewhere between 30 to 35% private, and the rest banks, depending on which country. We're at 15. And so we're seeing an acceleration of our growth in a number of factors. One, as I said, the maturity of the industry and the sophistication of the players thereafter. And two, the rest of the world looking at our market saying, these guys have got it right. The returns we're seeing over there are really good. The assets that they've got in terms of their property are stable, and they've got a long history, 30, 33 years almost of economic growth in this country, bar COVID. This is a great place to invest. And so why we're seeing that acceleration in growth in our private credit market is largely due to our domestic market becoming mature and a lot of high net wealths who didn't know about this asset class finding out and wanting to allocate. And B, international groups looking at our market and seeing fantastic risk-adjusted returns relative to their more mature markets and saying we need to be allocating to Australia.
Fantastic. Calvin, is there anything you'd like to add to that?
We took some stats that I was going to use as well, but I completely agree.
They could be right.
I completely agree. From the investor perspective, the transition of wealth that is already underway and is only going to accelerate is putting more capital in the hands of investors, inheritors, property sellers, business sales, and they're coming to advisors and saying, "How do I generate income?" So traditionally, there have been other products that have been used for that, but in this modern world, there's much better income that's available with I won't say the same, but relatively comfortable levels of capital security. So I think it's only got a lot of growth in it.
Travis and Craig have covered off the key points really saliently, but it's a combination of regulation opening up an opportunity set in that space. There's been innovation both on the product manufacturer side with really high quality fund managers, both coming to Australia and really high quality offerings available already in the domestic market here. Platforms are becoming more comfortable with offering illiquid strategies, notwithstanding the more recent high profile controversies in the media. And finally, it's just a case of the asset class having proven itself now over a number of years.
I think if I just add one final thing, we've seen that the government or APRA said no more hybrids for banks. There's billions of dollars out there rolling off, and I'm not comparing the risk of the two type products, but as a fixed income product, you've got all of this money now saying, where am I going to allocate the money that I had in bank hybrids? And part of that money we feel will flow naturally into private credit because people are looking for an absolute income strategy, right? Yes, it goes absolutely up the risk curve relative to what a bank hybrid would be, but that also we feel will contribute to some of the growth over the coming years.
And you touched on how things have sort of changed relative to the US market and overseas markets are quite different. We actually have a question in relation to the private credit market in the US. So thank you for this, Fabian. Private credit in the US is predominantly focused on lending to medium-sized businesses rather than residential or commercial property. Would we see this type of shift happen in Australia?
The simple answer is yes. The corporate credit market's already bigger than the real estate market in Australia by a factor. The 200 billion number you called, only 75 of that sits in real estate, with the rest of it in corporate. The big banks have a dominancy here, as everyone knows, which is now starting to be chipped away at. The challenge in Australia is just the opportunity set. A lot of medium-sized corporations, because of how well our economy is doing, have been performing very well. And so they're largely banked by the Big Four. And if you have a look at any Big Four bank report, you'll see that their real estate lending is very small and their corporate lending is very big. So some factor will have to change, and it's likely the international players like your Blackstones, your KKRs, your huge groups coming to Australia and offering more competitive rates to these borrowers to hit that mid-market of corporate credit. It is a very competitive market set out there for that type of credit. So I think the answer is yes. But I think in terms of reaching the velocity and scale that the US has, we're probably some way away. The other interesting fact just on why we don't see more real estate lending out of the US, a lot of the US market is BTR, not build to sell. And on a BTR projects, the dynamics of that lending is very different because you don't only have the construction on build to rent project, you have the lease up risk on the back end because you don't sell it. There's nothing, you can't get your money back until you lease it. And if I put it in perspective, in Australia, the build to sell market makes up 99.2% of the real estate residential transactions. Build to rent is under 1%. So the US market, that would be vastly different. I don't know the stats. Someone can look it up later, but the build to rent model isn't quite established yet here. And that's why for those build to rent players, they're normally very big, large institutions like Greystar, Investor and others who are coming with big balance sheets and they don't use the private credit market. So there's probably a little less opportunity in that set in the US. But if I just focus on what we do know here, the opportunity set, because we are over 99% build to sell market, it still presents a very compelling opportunity in Australia, particularly with the housing undersupply that we've got in the residential asset class.
I think that might be something we can come back to and talk about housing undersupply as well. Calvin, question for you now. Ratings agencies play an important role in assessing product quality and also communicating this to the advice community. What factors do you look at when evaluating private credit funds? And do these help reassure, or how do these help reassure financial advisors about the strength of the sector?
Yeah, sure. So there's a lot in that question, Julian. I'll just cover the really high level points because we can spend the whole session talking about, the signposts and the key metrics that we look for when assigning a rating to a private credit strategy. Governance is clearly, exceptionally important. Look, you can simplistically say that the gold standard would be, an external RE, but there's lots of nuances to that point. If a manager has an internal RE, but really high quality external service providers outside of that, then, that's okay. Outside of the just on the RE and the difference between the internal and external RE, I mentioned earlier, there's been a number of high profile, obviously, controversies in the private market space, Shield and First Guardian, instances there where potentially a lot of the fraud that took place could have been avoided had external REs been appointed. An internal RE is clearly less likely to challenge a fund manager that isn't operating in the best interests of the client or is operating outside of mandate. So there's that point. An independent board of directors is going to strengthen the oversight as well of the business. And investment committee that's independent to the investment team to make sure that there's high quality deal flow coming through. A risk and compliance committee that's external to the investment team as well, that's performing regular stress tests on the portfolios. You want them to have internal restructuring and workout capabilities. So, ideally, legal and compliance that are experienced in insolvency law, as an example. You want the lender to be in a position where if an issue does pop up, they're in a really strong position. So where they can take a seat on the board, they can force management change or force a divestiture of assets, maybe a debt for equity swap. If the lender is in a weaker position at that point, their options are going to be really limited. Clearly, you want the investment team to be experienced, ideally having experience through multiple economic cycles. I know that's not always or necessarily possible in Australia, given that it's a more nascent industry, but you want a really clear, detailed due diligence process that they adhere to that's repeatable with their security selection. Some of the other, non-investment related considerations would be fee structure and the opaqueness of the fee structure. Even down to the investor reporting that you receive. You want that to ideally include metrics around borrower concentration, industry concentration, credit quality, LVRs, just information that can you as the advisors and your end clients with as much information as possible. I've covered a lot of ground there. I would have left out a lot, but that's just really a high-level overview of some of the signposts that we look to.
Fantastic. I guess you touched on the governance side of things early on in that discussion. ASIC has got a bit of a spotlight on the industry at the moment. Do we have any key takeaways that have come out of this at the moment? And what are our thoughts on making sure that the best practice in governance and across the industry comes to the fore as a result of this? Calvin, I might start with you.
Yeah, sure. So, look, it is a nascent industry that is growing at an exceptionally fast rate. So with that, you can expect more compliance, more regulations, more regulator scrutiny, which is ultimately a good thing to strengthen investor protections, which is good. Ultimately, for the entire value chain within the industry, from a fund manager perspective, some of the key takeaways from that report were around, assigning an independent third-party valuer so that investors can be confident that the fund manager is not inflating the value of the loans. There's a lot of focus on conflicts of interest, how they're managed, opaqueness of fees, even down to the terminology that's used and a lack of consistency around the terminology around senior secured, mezzanine, investment grade. And that's where research reports, as an example, are a key tool that you can use there to help distill that down. But in terms of the benefits for the fund managers that are incorporating the recommendations from ASIC, you're likely to see a flock to quality. So the highest quality fund managers are going to receive the most flows. The advisors are able to use a lot of that material as signposts for your due diligence. It helps with the questions that you need to ask the fund managers that you're reviewing. And then for the end investor, it's only going to be positive having greater investor protections in place to build greater sense of trust and confidence in the private credit community.
Travis, do you see that as something that's going to be able to flow through in discussions with investors as well?
Yeah, I think it already is. If I speak from experience, the 4 or 5 partners that we work with all contacted us and following ASIC's release of their report and said, here's how we have already complied with their findings and here's how we've already instilled that into our business. That was really, really reassuring. But from an investor perspective, it can only be a good thing because it does get confusing, even as advisors. And we look at these loans, almost every day. You always see something different. A notes, B notes, stretch loans, higher LVRs. There's always something. I just recall looking at for the first time and thinking, "Hang on, what is this? What does it actually mean?" So I think that will probably be gradually removed from the industry to have more similarities across loans and just and more uniformity in the way that loans are communicated to potential investors.
Fantastic. And Craig, yourself?
I think it's all pretty much said. As a fund manager, I think we certainly welcome, you've got to be careful what you wish for, but we welcome some of this regulation. I think that, as you said, transparency in investing is good for everyone. It's not only good for the investor, it's also good for the end user, the borrower. using firms that are highly transparent, have clear process and procedure. For the investor, having a level of transparency, but also regulation that says if I go and invest with this group or that group, the terms are the same. What I'm investing in, if it's a 65% loan to value ratio here, is the same as here. I think all of the proposed regulations, which ASIC is due to release next month, I think it is, they've put out a white paper with some suggestions, are all very sensible things for managers to think about. The larger groups, I think, as stated, are going to be the ones that have already put it in place, at which we're one of those. We've looked at the recommendations. We've said, great, we're already doing half of this and the rest is just tweaks to what you're doing. But what it will do is, for some managers, create either a stay or leave proposition with a huge upskill to get to where you need to be for the base regulations, or we need to leave because we're nowhere near it. And for the investors in that, I just see safety. And again, people often say to me, what's your biggest concern around the market? And it's often not the market as in the economics of the market or the lenders or the borrowers or the investors. It's another manager doing something to taint the whole private credit market. And so if we get in a base level of regulation which can help to protect not only the private credit market but investors and borrowers, I think it's a really good thing.
So one of the things that I guess has been a concern as part of that lately is the illiquidity in certain cases. And obviously we want to make sure there's transparency around that process and suited to the right investors. How do you balance the liquidity side of things while also ensuring strong returns for investors?
Yeah, so I think the first part to that is education. Anyone coming into a credit business thinking that they're going to have daily liquidity, unless it's in a product specifically designed like that with very clear instructions on how they have daily liquidity, isn't doing enough research. But what I'd say is private credit lending as itself isn't a liquid practice, right? Anyone in this room that has a home loan doesn't expect their bank to ring up tomorrow and say, pay me back, please. I've got some people that need their term deposit back, right? But what you get for that is an illiquidity premium, right? So the rates of return that you receive on the products that you get in a very modestly geared loan to value ratio on a senior secured loan, the rate of return is in part an illiquidity premium for you for being in a loan that is 12, 18 months long. The answer that I'd give you on how do you then look at managers that you're working with, it's looking at the underlying products that you're investing in. What are they then using your money for? If it's a pooled fund, is it long duration assets or is it short duration assets? How do they ask your manager, how do you provide liquidity? And if I just use the simplest form of, because I'm talking hard to describe, we've got a pooled fund. It's a first mortgage fund. It has about $500 million in it. It's got about 70 to 80 positions. And the average duration across that book is, I think, about 7 or 8 months. So every month we get a large portion of that repaying, which is your liquidity in the fund. We ask for redemptions 30 days out from that fund. So at the start of each month, we know exactly what we need. If we don't have inflows, which you typically don't at the start of the month, when we are repaid from the loans, we hold the liquidity until we've met our forward liquidity needs. At the point that we've then got more money than we need to redeem, then you can start reinvesting that money. So managers that have very clear processes and plans in place for managing liquidity across particularly pooled funds, which is where you see loans grouped in together, I think you'll find that liquidity is not as big an issue. And then you ask questions which naturally will be the next. Well, what happens if everyone wants to redeem? And so some managers like ourselves have different terms of when you can redeem. And again, it's a protectant for the people that are in the pool, so you don't get a run on it. And it's also a illiquidity premium that you receive for investing into that pool of assets. So it's complicated is the answer, but a well-educated person who's coming to talk to you about the product will easily be able to talk you through the process and procedures that managers have in place. As advisors, if you can't get comfort around the liquidity that someone's offering you, that's when you should question the investment.
And part of that too is if there's a lack of comfort, how do different parts of the industry, be it product providers, rating agencies, advice groups, how do we work together to make sure that we are sort of working towards that point where we think, yes, that is what's really driving confidence? What are the discussions sort of happening between groups?
I think it's about, from my perspective, educating clients around how the asset class works and understanding what their intentions are with the investment. So we commonly hear, there's been a capital gains tax event and someone has a tax bill in 9 months, they want to put their money into a private credit fund or a senior secured loan. We've learned to say no in those situations because it's simply not appropriate for that purpose of what they want. Investors are looking at the returns and thinking, this is great, everything's going to go right and I'll get my 9 and a bit %. And that's true if everything goes perfectly, but it doesn't always go perfectly. So we've had to remove those risks and really push back and say no. And over time, in my view, it's at least a 2 to 3 year, closer to 3 year period of investing your capital commitment before you can really look at this asset class. Of course, you can get access to your money earlier, as Craig explained, if everything's going well. One thing I'll say as well, my comments coming from the perspective of direct loans. We have a preference for deal by deal, which can sit alongside a pooled fund as well. But using that in our business allows us to create a liquidity, rolling liquidity of different loans, which is exactly what Craig and his team will be doing, but at the fund level. So you can structure loans to provide some liquidity as well.
And in terms of yourself, Calvin, looking at the SMA side of things, what is the future there? Can you give us some insights into how these are going to become more accessible through different platforms?
Yeah, so as I mentioned, historically, it's been really challenging to get illiquid strategies into a daily liquid SMA. We have seen product innovation more recently taking place from the platform perspective around, potentially carving out a portion of the portfolio when you're rebalancing, but where the different platforms are really disparate in terms of the technology that's on offer. What we're seeing across the industry is a move to offering, purely illiquid SMAs where the clients go in eyes wide open, comfortable with, the illiquidity there, the restrictions around rebalancing and withdrawals that can sit alongside your daily liquid investments as well. I know for a lot of you in the room, historically, how you've got access in a daily liquid format to an illiquid asset class has been LICs and LITs, which clearly in stress markets have the potential to trade at really steep discounts. And we're seeing a lot of innovation from the product development side from fund managers, offering things like listed notes as an alternative. So securities that have a defined end date where you get paid your money back that still trade on the ASX, but it just gives greater confidence that will trade closer to NAV.
Question that we've received from Ben. So thank you very much for sending this through, more around the allocation side of things. And obviously the Australian market versus other global markets are in different levels in terms of Australia's relative infancy, let's call it. What do we think the Australian versus international split should be when we're talking portfolios? Travis, do you mind if I start with you on that?
Yeah, sure. Full transparency, we only do Australian real estate lending. We haven't seen the need to go offshore. Maybe one day, but given the strength of underlying property values in the country over a very long period of time, even if that was to taper off, I think the part of the market that we're all operating in and talking about would still be reasonably secure. So there hasn't been a need to go offshore. Could introduce some more complexity that we just don't think it adds the value just yet, currency risk and whatnot. So we're very comfortable with just Australian real estate secured lending for the time being.
Makes sense. And is part of that as well, if we're talking international, there's the physical side of things too, being so far away. I guess, would you consider that adds another layer of complexity?
100%. We receive documentation. We look at we want to know where the loan is being made, what areas, so geographically. Obviously, naturally, you're less familiar with that when it's outside of Australia. Independent valuations taking place. Again, it's just layers of complexity that one day we might get there, but we haven't had to just yet.
Yeah, that's fair. Craig, you getting that question as well? Obviously, international is not the bread and butter.
I'm probably a bad person to ask because we're only Australian. The international market is very mature, and America being the most mature for private credit, it's a great market. The yields over there are perhaps a little tighter than what you'll see here, just because as a market matures, you get more money in, you naturally get a tightening of spreads over base rates relative to banks as you get to full maturity, which is where the US market probably is. This is real estate lending I'm talking. In Australia, you've still got, because we are a maturing market, you've still got a divergence of returns across different managers for similar product. And so having or talking, as Travis would, to multiple managers, they'd see some great opportunities. It doesn't mean the risk is any better or worse with those. It's up to the advisor group to look at different managers and how they conduct their business, and things like, what are the fees they charge that can impact returns, but not necessarily change risk. And And so these are the questions you need to look into from an Australian perspective. What I would say relative is just, and Travis touched on it, the part of the market we're looking at, and I think you're referring to residential asset class or residential backed private credit here. It is a distinct part of the market. And over 80% of our book is in the residential asset class in that mid-market sector on the east coast of Australia. And there is a pure thesis there behind the housing undersupply. We feel like mid-market, what I mean by that is debt sizes or loans to developers between sort of 10 to 70 million. We feel like those projects are less complex. We feel like if something goes wrong, you've got a deeper pool of buyers there to go and purchase the asset if something goes wrong. And we feel like, particularly of late, if you're on a mid-sized project, and what I mean by that is 7, maybe 8 or 9 levels on the outskirts of a city. So in Melbourne, it would be in Footscray, Camberwell, Brighton, these sort of areas. Not only do you have a very strong underlying demand, it's generally a less complex build than a tower in a city. We don't do towers in cities. We just see too much fundamental risk on not only the builder, but sales risk at the end. One of the issues in Australia in construction is if you want to build over 50 stories in a major city, you've got 3 or 4 builders you can choose. Right, that's it in each major city. And we saw Roberts Co. fall over in Melbourne. If you're on one of those projects, you've got 12 to 18 months before another builder can step in and pick that up. If you're in a mid-sized project in Brighton, you've probably got 10 or 15 builders that you can go and find to come and step in behind a builder. And these are the practical aspects of private credit. If you're doing hard assets, you need to actually be across in the markets you're lending in. So that middle market residential, we feel, is very strong right now. We feel it's got a long runway. We feel like there's risk mitigants on mid-market relative to the top end and the lower end. And so that's why I think that's what you're referring to. We focus on those areas of risk.
And Calvin, in terms of the portfolio side of things as well, are you having those conversations around the international side of things relative to domestic?
Yeah, absolutely. So how we typically build out the framework for our SAAs will be through a capital markets assumption process. So it does become more challenging in the private market space because, to state the obvious, there's no market for private markets. There's no beta that you can get exposed to. It's really the manager that you're partnering with. So if I had to crudely put a number on it, it'd be approximately 1/3 Aussie, 2/3 global. We're in a really fortunate position where we've got a deep research team who are able to travel offshore, do the DD with these managers on site. So a number of them are over in London at the moment undertaking that DD. And that's then how we build out our APL of fund managers that we're using.
In terms of the investors, now a lot of them are on the sort of high net worth side of things. And one of the questions we had coming through was looking at if the definition of a wholesale investor changes, do we expect that changes much from your perspective, Travis?
To change who can invest in the funds?
Yeah, is that going to have much of an impact on how you're educating clients?
Probably not, because there's so many, as the market has evolved, there's so many retail accessible products that are listed on the stock market or that are retail focused, managed funds. So I think the education part still remains the same, no matter the quantum of wealth that someone holds. So I don't think it'll change how we educate clients. Yeah, probably a good thing for the market if it changes slightly, because it's been many decades since it was last changed. But potentially, I think the only risk at the moment is there could be some strategies or some funds where investors are making commitments to that aren't appropriate, or they don't understand what the capital is actually being used for, and they might be shocked if they lifted the hood and took a closer look at what was actually going on. So it wouldn't change too much in what we do, but it might be a good thing over time.
Yeah, makes sense. And Craig, would that have any impact on yourself?
Well, interestingly, we looked at the proposed changes. There's been a number of different things proposed, but each time they come out with something and we run it over our book to see what it would affect or who it would affect, because we keep wholesale certificates for each of our clients. We know our clients pretty well. And on each of the suggested changes, the people that wouldn't necessarily qualify just on amounts invested or what we know about them is a very small part of the bottom end of the book. And so, no, I don't think that it would have a huge impact on our client base. And I think, as Travis said, if you don't index something for so long, are you, and or there's ambiguity around, is the family home included? There's a lot of people that fall into the wholesale definition from having lived in the same place for a very long time and may never have had any sort of level of sophistication around financial assets.
Thanks again for those questions coming through. Just a reminder, if you'd rather pop your hand up and ask a question, Any time's fine. We've got a question over here, Matt. We'll bring you the microphone.
Craig, I've answered this before. To some extent, when we get more competition coming into Australia, we may expect returns to come down a bit. Would you also expect, I know when the US was saying probably credit quality come down a bit, so more covenant light loans been written. Do you expect that's a risk, and how would we identify when that's starting to happen in the Australian market?
Yeah, it's a good question. So if there's more competition, do people take more risk? I think is the ethos of that. I think part of it will be dealt with by regulation. I think having a base set of what we prescribe as you're investing into, so the same covenants and terms and so forth, will help investors decide. I think we've got a little way to go there. The market here is still relatively small, albeit growing, before we get to that full maturity stage where we're seeing margins squeezed so much in our market. And the other thing I'd say is Australia is a little bit different in terms of how our legal system's set up relative to some other countries. And we've had some offshore investors we've been talking to recently describe our laws as lender-friendly laws, or the laws in Australia protect the lender quite well, built off the British system. And so therefore, if you set your business up to use a first mortgage or a senior secure, which 95% of our book is, you get the natural inherent protections of the legal system on which we work in. It's hard to deviate from the protections that come with that. If you're playing in, as you said, covenant light or perhaps second mortgage space, I think that it does open the door to potentially taking more risk to seek yield.
If I could add, I mean, we know that internally, we know that increased competition, it does increase the risk. We're seeing it at the moment with the partners that we work with. And I guess the best of breed out there at the moment don't have a long list of loans because they're not seeing the quality that they want to participate in. But there's a big pool of lenders out there that are raising LVRs, dropping rates just to attract business. And that's certainly not a good thing for investors. So we do need to be careful.
Thanks for the question. One of the things I wanted to circle back to that you mentioned before, Craig, was housing undersupply and how private credit is addressing this. It's obviously something that's in a work sense important, but also in a wider social context, it's quite an important conversation at the moment. Can you touch on how the industry is addressing this?
I'd love to say we're addressing it. I think we're playing a part.
Yeah, of course.
In the ASIC report that was released, one of the acknowledgements was that private credit as an asset class plays an important role in filling the gaps that the banks can't because of regulation. Part of that's Basel III, part of it's Tier 1 capital constraints, part of it's... There's a whole myriad of issues, which I won't go into. But what we do see private credit as an important part of the housing undersupply is... Why do people, and you asked this before, why do people pay more to come to the private credit market? Why would you pay a borrower 10% when you can go to the bank and get 6%, right? And then the normal spread, just for everyone, is somewhere between 4 to 6%, depending on the loan type, to what you'd pay at a bank, as a general rule, right? It's not always the rule, but as a general rule. Why would you pay more? And the simple reason is private credit is seen to give you more speed and more certainty around your lending facilities. So a big part of why people come to private credit is something that I've heard others say is what the banks call what they call the banks giving them a slow no, which is I think we're there, it should be good, I think we're okay, and last minute, oh sorry, credit said no. And that frustration's led developers to what they used to do is go to the bank, find out if they could get credit, and if they couldn't, come to the private market. What we're seeing more and more now is lenders starting at the private market, locking in the fact that they can get their credit and then seeing what the bank will do. So it's a big shift in what we're seeing today. And that's why we're seeing so many really good corporate and real estate lenders move from the banks into the private markets, and why we're seeing the growth partly of our market. But what I would say to you around addressing is, in general, the private market will require at our firm, we're what we call a near bank lender. So if a client wanted to borrow with us, they could perhaps get 1 or 2 more pre-sales, or they could put in a little bit more equity, or they could, do a myriad of things that would get them to bank finance if they wanted to, but they might want a slightly higher loan to value ratio and keep some equity for another project. They might not want to get the high level of pre-sales early because they see the market rising in front of them. And if you lock in your pre-sales at a fixed rate now, which you do with pre-sales, your revenues are locked and your costs might move, right? So a lot of people are coming to private credit to get that speed and certainty and flexibility, start a project earlier. And I think on average, the private market will start a developer somewhere between 6 and 12 months earlier than a bank might if they were getting the extra pre-sales or putting the extra, all of those things. And so where we feel like we're helping is we're accelerating the growth or the rebuild, if you like, or the building of residential housing, particularly by getting projects started earlier than they may if they needed to go to a bank. It doesn't mean that we're doing projects that banks would never do. That's that risk factor that Travis is talking about. It just means that we might be getting them a little bit faster because of some conditions that may not be as stringent as what banks are forced to apply to some lending.
There's also periods as well where public markets seize up, where, for example, we saw that around Liberation Day where borrowers were unable to tap high yield or syndicated loan markets offshore. So those that had existing relationships with private credit managers were still able to receive financing through that period.
Question for each of you, and just a reminder again, I'm happy to take some more questions coming through. Do you believe private credit is well positioned to remain a core part of client portfolios over the next decade? Craig, I think I'll start with you on that one.
As if I'm going to say no. Look, the simple answer is yes, and not because I'm in private credit, because I look to more mature markets and see what it's done in other jurisdictions. Right now, there's still some ambiguity about where our asset class fits. As stated earlier, is it fixed income? Is it alternatives? Is it alternative fixed income? Is it a derivative of property? I think over time, you'll see private credit, like it does in other markets, become its own asset class. And I think it'll play absolutely an important role, and there'll be a natural asset allocation to the private credit asset class that sits adjacent to a fixed income part of a portfolio, which will be more in your traditional bonds and other pure fixed income types instruments, but not advised, right? I'll give it to the guys that do it every day.
Yeah.
Definitely think it's got a lot of growth left in it. I mean, our track record of recommending it to clients for 30 years is testament to that, and I can't see anything that would change that. The industry goes through push and pull with having too many deals or too much capital. So I think over time that'll continue. But as long as the quality of the industry continues to raise regulations, continue to support that, it can only grow within client demand levels.
I made the point earlier around asset class having proven itself. You're getting really attractive high-level base rates. There's clearly an illiquidity premium at play. There's a correlation benefits when blended with listed credit and equity markets as well. But I mean, in terms of it becoming a core part of an investor's portfolio, clearly the adoption of a lot of those ASIC recommendations will be key to really build out the maturation of the industry. Strengthen the investor's sense of trust and confidence in the private credit landscape as well.
I think if I may, just one of the points there, the uncorrelated nature of private credit is really important, worth calling out. A lot of advisors use private credit because it is uncorrelated generally to public markets. And so if the stock market has a correction, generally the value of that real estate asset won't change significantly. The value of the mortgage against that asset certainly won't change. And so it's that uncorrelated nature in its pure sense that people see some comfort for. And with the illiquidity that you get in this asset class, sometimes it can also protect investors from putting an immediate rush sell on something. And we saw that in COVID, we saw a lot of fear and people saying, quick, the value of this real estate's going to go to zero. We're all going to die. Quickly sell, sell, sell. And obviously you couldn't because you're in a longer term mortgage. And in fact, the post-COVID period after May, when we all panicked and then June moved on and realized that we could deal with this, we saw, and a lot of private credit managers saw their books grow faster than they had in a long time, partly because rates came down so much, but equally because the real estate asset class, which underpinned the debt for a lot of people, particularly in our business, was powering on through that COVID period.
It has also been very misunderstood for many years, and I think over the last 5 or 6 years that's changing. So, 5 to 7 years ago, if you spoke about real estate lending, many in the industry advisors would say that that's high risk. But I think that's certainly changed, there's no doubt about it, and that's got a long way to go, which will further support the growth of the industry.
Just wondering, can you guys give us an example of where you've actually had a significant loss in your portfolios, or you've seen them? Just, I suppose, what happened, and was the low LVR enough to protect you? Just curious.
Do you guys want to go first or you want me to go first?
You go.
I'm happy to go first. So I can't demonstrate a significant loss in our book. There's been no doubt that we've had defaults where we've had to step in, take possession of assets and sell them. In a first mortgage at 65%, I'm very careful here because the ASIC report says recently saying that you've had no impairment or losses. Impairment, yes. We've had assets that have become impaired that we've need to enact our powers under our mortgage, take possession, sell the asset, recover the money for our clients and repay the debt. We were recently noted, so this is public, and if you Google it, we were noted as a borrower against an asset in Queensland recently, and we went through a sales process. The loan went into default. As noted in the news article, we had a low level of gearing against that asset. It was in Burleigh, Old Burleigh Road in Gold Coast. We took possession of that asset under our powers of mortgage. We ran an on-market sales campaign. We've sold the asset and we will recover all of the funds for our clients that they had against that. It's a prime example of a low level of gearing or an appropriate level of gearing against real estate assets can protect you in a downside scenario where the borrower defaults.
Our experience is similar. We've, over 30 years, we've had no clients lose on a total return basis. There's been one or two instances where they've had a very small haircut on their capital, but the interest received throughout the loan has made them whole plus a profit. We had one the last week where it was sold at auction. It was taken possession by the lender. It was sold, so investors will receive 100% of their capital. Instead of receiving 11% interest, they'll receive 6%. So that happens. It certainly happens. And part of our role is to explain that to clients up front. You will experience defaults. That doesn't mean you're going to lose capital. It means you might not get interest for 3 to 4 months while it's remediated. But I feel very secure that if done correctly and you're sitting in the right part of the market for what you're expecting, the capital security aspects are there.
I think it's a really good question and thank you for it. It's a question that you should ask any manager you're talking to. What happens when something goes wrong? We're in property and lending. Anyone that says they've never had a default in a book is either lending too conservatively or not telling you the truth. But that's not the question. It's what happens. What do you do? What's your process? What's your procedure? And how do you manage through it is really the answers you're looking for, I think.
And the worst thing that can happen when there is an issue is if it's allowed to go on for too long before action is taken. So it's important to work with a group that has experience working out issues and has done it before successfully. And they can step in at the right time after working with the borrower, but not being too late to actually fix the issue and take care of borrowers, a lender's interests.
I think we have another question, Sanjay.
Thanks. We talked about illiquidity versus liquidity, and we talked about investors, etc. Now, this is a different asset class in fixed income, as you said, Craig. Now, how would you convince if there is a lot of growth potential in Australia in the private credit market? How would you influence or talk to the investors with respect to ETFs?
ETF?
Because that's a different class. But how would you try to influence them to go into private credit as such?
Well, we don't give advice, so we don't influence anyone, just for the record. But look, I think when investors are interested in our asset class, the best we can do is educate them fully on what we do. And ETFs, I think, carry a very different risk profile because they're generally, I think you're talking about ETFs attached to an index or which is an equity or stock index. Equity and debt risk are two very different risks and they carry with them different things to consider. What I would say to you is over the last 10 years, we've tracked the performance of our fund. Just in our first mortgage style fund, it's returned somewhere around 8.5%, give or take. Don't quote me on the exact number, I can give that to you, but it's about 8.5% over the last 10 years on a first mortgage. So that's for us, that's up to 65% loan to value ratio. If you compare that against the ASX 200 accumulation index, I think it's about 9.5. Whether you think there's different, it's up to you then to decide which one carries more risk and which one do I think is a good place for my funds to invest. Throughout that time, the capital deviation of our fund was 0, right? So because it's we had no capital impairment in that time. And so if you put $1 in, you got $1 back in 10 years and you got about an 8.5% return. If you look at the ASX 200 accumulation index, it's definitely not a straight line. it moves like this over time. And so volatility of capital is something that's often different in the sense of comparing ETFs to an income style product. And that's the key comparison for investors to think about for their own circumstances. Where is, for their portfolio, am I better in an equity style or in a debt style product? And how do I get comfort around that? My portfolio allocation would be my non-advice answer to you.
In terms of questions, I think we'll sort of stop it there because we're getting towards the end of time. I'd like to get one quick word from each of you. As part of the Advisors in Focus event, we want to at least be able to have everyone go away back to their practice and say, this is one clear thing that I can take with me, at least one, of course. Is there one thing that you can quickly wrap up that you think would be a good takeaway? I'll start with you, Calvin.
Just around the maturation of the industry, the adoption of the ASIC recommendations, that flight to quality within the industry, the highest quality fund managers that adopt those recommendations are clearly going to see the most flows. And it also comes back to the point I made earlier around private markets not being a homogenous market, that you're really partnering with the fund manager that you select for the long term. And so there's an education piece around that as well, both for the advisor and the end client as well. So it's just all about elevating the standards within the industry and then strengthening the investor protections as well.
Travis?
I'd say as advisors, we need to be educated first. So it can be overwhelming with how many different private credit managers and options there are out there. Every day it feels like there's a new one that's landing in our inbox. So having conversations and understanding, asking the questions that you might think are silly, but you need to learn yourself around what part of the market and who you're talking to and what they specialize in and their history. So I'd encourage you to have those conversations and don't be afraid to ask questions.
I think it's been captured really well. I'd say to those that are listening and here, if you haven't got private credit in your portfolio, explore it. Doesn't mean you'll do it, but I think you should explore it. Educate yourself around the different aspects of private credit. Private credit is not one asset class. It's many different types within the sphere of private credit. If you are in private credit, just make sure you understand what the underlying investments are that you're actually investing into. So education is, I think, key. I think whilst we are still a maturing market, for a long time, education is going to be the key to success in private credit. Understanding who you're working with, what you're investing in, what are the key risks, and how does the manager you're working with navigate that? I think if you do all of that, which falls under the education banner, I don't think there's many that wouldn't find a place for private credit in a portfolio.
Fantastic. And to the team at HMC Private Credit, partnered with us to make sure that the education piece is actually being discussed here. So just wanted to thank the team, Craig, and if there's a final word for yourself to talk about, what's going on, if there's any other specific takeaways with HMC that you wanted to put forward, I'll leave that to you to round that one up.
Oh, look, again, the other thing I'd say is at HMC, we firmly believe that the residential mid-market asset class in Australia is a phenomenal place to look at right now for risk-adjusted returns because of the underlying dynamic of a housing shortage supply, the speed and lower complexity of the mid-market typically, and the need for the product. And so if you are considering private credit and you're looking at different risks in market, we'd love to talk to you more about our investment thesis and how we're delivering circa 8.5% to 10% returns for clients on a first mortgage basis, which we feel presents a phenomenal risk-adjusted returns for an investment opportunity.
Thank you very much. Before I move to some housekeeping comments to wrap up, can we please have a round of applause for our panellists?
Thanks for listening to this Financial Standard podcast. For more information, visit financialstandard.com.au. Please keep in mind that the information discussed in this podcast is general in nature and does not consider personal circumstances. Reliance should not be placed on any content without further independent financial research and advice.